Thanks for tuning into this very special broadcast. 44% earnings growth, that's a tall ask. But Citi India expects stocks tracked by the Citi universe to achieve this feat. But, and it's not a big one, a lot is riding on banking space, says the global brokerage house in its earnings preview report.
So how is riding on financials and what happens to other sectors? Joining us now, like always, in the lead up to the earnings season are four experts who have worked very closely on this report. Surendra Goyal, Head of Research at Citi India, and his colleagues Prashant, Nair, Raashi, Chopra and Aditya, Mathur. Ladies and gentlemen, thank you so much for coming to the show. First of all, let's start with you, Surendra. 44% growth, that's a tall task, but that's only on the back of financials. Otherwise, you see a decline as far as earnings is concerned. What's the sense? How did you arrive at this number?
Sure. So thanks for having us here.
Pleasure.
So see, the earnings, I think you have to keep in mind that there is a really low base in financials last year.
Okay.
So that's the reason why you see such a big number, and which is what is helping the overall number of 44%. If you exclude financials, what we are expecting is flattish kind of earnings year over year.
Okay.
So it's largely financials driven. If you look at the other sectors, there are a lot of sectors between 8 and 13% earnings growth YOY, and then discretionary is down some 20+% YOY. So at an aggregate level, the remaining sectors are pretty much flattish, and because of the low bank in financials, the number appears very high at 44%.
So would you say that probably you expect the earnings season to be disappointing because it will be held only by financials this time around? So
again, we have put out expectations based on whatever we understand and we pick up from corporates when we meet them, etc. So I think people will be watching out for surprises, if it's higher than that or lower than that. I think what is important here is, despite this 44% expectation, the full year number is 11%.
Okay.
And if you would recall, when we started the year, this number was 24-25%. So we have seen a 14% downgrade, and which has been pretty much the story for the last 4 years, where we start with a high expectation and then there is disappointment, and which we think is the biggest challenge, and that's the reason to kind of focus on. Because what you could have is, firstly, the numbers obviously are important, but what happens to the numbers for FY20 from outlook perspective is equally important.
And I'm just wondering if that actually aids that outlook for FY20 as well. I know we're talking about Q4, but just broadly within your respective sectors and within the overall universe as well, if indeed FY19 also fails to deliver and would come in at 11, 12, circa that number, that leaves us with a in a very sweet spot when it comes to delivering earnings for FY20 on percentage terms, if indeed India Inc. manages to find its mojo back.
Yeah, so I think what you said last is most important, if India Inc. manages to find its mojo back, because the same argument was there last year, the year before and the year before.
Yeah.
But last 4 years, every year we have had earnings disappointment. So there is a low base every year, and yet we have a downside surprise. So I think getting the mojo back is important. Without that, to us, and what we have written in the preview, is that the 20+% expectation for FY20 also does look optimistic when I look at it.
Interesting. Well, and yeah, a lot of one-offs that have happened as well every single time, and nobody's fault, but it's just nearly impossible to guess. I mean, what could have happened to a Tata Motors in the quarter gone by or otherwise. But let's start off with some sectoral themes, and then we'll come back to the overall earnings. Surendra, if I can start off with IT,
sure.
Since you track that space very, very closely, and we're on the cusp of those earnings coming out. What's anticipated from this space? What do you expect the two big boys to deliver, and what should one watch out for?
Sure. So I think in IT, we have had good last, say, 6 to 9 months. We saw a bit of a pickup in deal flow for a lot of companies, and growth rate actually improved in the second half of last year. But at the same time, you have the global macro, which is weaker than, say, same time last year. The rupee, the benefit which was there last year is no longer there so far this year, where the rupee has been stable to appreciating. So at the margin, those things have turned worse, but the deal flow was decent. So what our expectation is, from a quarter perspective, we expect a steady quarter. So this is the March quarter, which is a seasonally weak quarter.
Okay.
So in that context, I think what we are expecting is a steady performance. But I think what is important is data on deal flow, management commentary, and the outlook on margins. Because that's where, if any of those change, then people may take it negatively. Because if companies come and say that the outlook is not as strong as it was, say, 3 months or 6 months back, or because of rupee, the margins are going to be under pressure, or the deal flow data itself is weak, because then people will start worrying about the macro impact on the sector. So those are 3 things which I would really watch out for.
especially Infosys and TCS, what would you watch on?
So I think again it's company specific. I think in TCS, it's their outlook, okay, and the commentary on margins. In Infosys, they have had a very good deal flow acceleration in the first 9 months of this year. The large deals that they announced are up 118% compared to the same period last year. So the revenue momentum seems decent, but there are concerns around margins. So I think Infosys, what we are expecting is revenue growth guidance of 8 to 10%. Assuming that's what it is, then the focus will shift entirely to margins. Okay. If they can keep the band, last year the band was 22 to 24, if they can keep that band, will it be a little lower? Or what they say on that, I think that will be very keenly watched out.
Okay. Let's talk about the other spaces as well, and we'll come back to financials in a bit. Raashi, if I can come to you, within your coverage universe, what's the expected run rate, and what is it that you would watch out for in terms of commentary? What are the companies that you believe one should watch out for, or that you are watching out for?
So it's divergent in metals and cements.
Yeah,
so
let's start with metals maybe.
So on the metal space, we saw that the fourth quarter was actually one of the weaker quarters as far as steel is concerned, right? So we will see a contraction in steel prices coming through in the metal space, and therefore there will be an EBITDA per ton contraction. Having said that, where we stand on a spot, like spot realization or spot EBITDA per ton perhaps is better than where we were in the fourth quarter. So I think more than what we see in the fourth quarter, the market will be really looking for what happens to spot realizations. And that, I think the data points that are coming out from China, while they look good at the moment, generally our view is that there should be some slowdown over the next few months in the property data that comes out of China. And therefore, we're not really sure of the sustainability of where we are on the spot EBITDA per ton. So we actually continue to remain negative on the steel space.
Okay. So irrespective of what the delivery of the quarterly numbers might be, and you might not be able to comment on some of these names, but the ones that you cover and can comment on, maybe a Tata Steel, maybe some of the others, even if the number delivery is good, you would largely remain circumspect about the prospects of the companies, stock prices.
Yeah, so I mean, I don't think the numbers delivery will be good because we're expecting a correction in the steel prices in the March quarter. Okay, fine. The current quarter is better than the March quarter. But you're rightly saying that the market will actually look beyond where we are in the fourth quarter. Tata Steel, more specifically, I think the one number that always creates some sort of uncertainty is the European number. So, you know, that is one number which we'll watch out for the quarter more specifically.
Are you concerned about the news coming to Tata Steel? Are you more concerned about the news flow that's coming in from overseas in terms of Tata Steel and the merger? Because, you know, every day you keep on hearing more and more voices indicating that they are opposed to this merger. So is that a given that this merger will happen, or are you concerned?
The one thing that we've been highlighting for a while is that we are concerned on the timelines. Okay. You know, because I think there's a large part of the investor community that's kind of working with a Tata Steel X of Tata Steel Europe, which effectively makes like some amount of debt, about $3 billion of debt, go out of their books, right? But that basically becomes the tricky point here, because if this merger keeps getting delayed, then that $3 billion of debt continues to stay in the books till such time the merger gets delayed. So I'm not specifically concerned about the merger not going through, but the concern is on the timing and the contours, you know, because if they have to divest some assets and if there's any change in the contours, then that uncertainty remains.
What about cement? Because we've seen multiple reports come out in terms of price hike. The southern markets especially took much more price hike. There was some rollback, but then, you know, again, the momentum. Do you think this time around cement will have a decent quarter?
Absolutely. So, you know, first talking about the fourth quarter. In the fourth quarter, I think that the bulk of the price increases came largely in the southern markets. So the players that are exposed to South India should benefit the most. But as we move past March, I mean, we've seen in the month of April that price hikes have basically come through across all regions, and the news flow keeps continuing. You know, week after week, the increments are different. So despite the rollbacks, I think the extent of the increase has been pretty decent. So where we are today, perhaps versus like February, we've seen almost maybe anywhere between 20 to 40 rupees a bag in the non-southern markets, and in the south, it's, you know, between 50 to 70 rupees a bag, which is a pretty big delta. Additionally, I think the fourth quarter will also see some cost benefits coming in. You know, so there should be reduction coming through in the petcoke costs, and some companies that haven't got the full benefit of the axle load increase, you know, they will see some decline in the freight costs potentially. And I guess you know, the companies keep continuing working on their efficiency parameters. So all in all, the March quarter should actually be good for cement. We will see an EBITDA per ton expansion. And as we sit like on spot, that EBITDA per ton should be even better than where we exit the March quarter.
So potential positive surprise from Ultratech.
Yes, so the thing over there is it's, because Ultratech is spread across India, and we do know about price hikes across various regions. I do believe that the price increases the blended price increase may just be a little bit better than what we've kind of forecasted. Second is that, as they ramp up on the capacities that they've acquired, the efficiency gains could maybe be better than what we anticipate.
Let's wait and watch. Before we come to the other sector, Surendra, you want to add something to these spaces, because a lot of what happens to the capex goes into these two spaces for sure. What is it that you guys are observing there?
Yeah, so we are seeing a bit of improvement on the investment side. So if you see the GFCF data in the GDP data over the last, say, 9 to 12 months, it's been looking much better than the past. So to that extent, yes, you are right. We are starting to see some of the pickup, and cement is one sector we like, not only from a fundamental perspective, which Raashi also already spoke about, but also the positioning. When I meet a lot of investors, people have been negative on this sector, and possibly rightly so, given that earnings have been disappointing for a very long period. Yeah. So the positioning is also a little light, and that generally works in favor whenever the cycle turns. So a lot of people are asking us about the positive view on cement, and which is why we have it as one of our big overweights, even in our model portfolio in India.
Okay. Surendra, before we move to Prashant and Aditya, just a word, because in the report you've written that industrial, especially capital goods, is one of the lone bright spots this time around. Are you referring to pure play capital goods like a BHEL or a Thermax type, or would you include construction companies? So I just wanted some bit of clarity. And why are you bullish? Because the order inflow, no doubt, for L&T has been superb, but the other pure play capital goods somehow haven't been able to show order inflow as well.
Yeah, okay. So there are a couple of things there. That comment pertains to the MSCI industrials basket, okay, which includes a lot of names, yeah, okay, so which are not related to the sectors which you spoke about. Okay. It may include airlines, for example, in industrials. Okay. That's how MSCI breaks it out. So it's a combination of lot of things. In some of those names, we are seeing a very nice improvement either in margins of a very low base, which is why the number looks good. In some of those names, the top line looks good, but as you rightly pointed out, it's not for the construction space. Yeah. Right? Given the whole liquidity situation, etc., everything put together, it's not in construction, but in other parts of industrials, whatever is there in the MSCI basket, which is where we are seeing those numbers. And at aggregate basis, that's why the number looks like 20%, but yeah, not construction, the remaining part of it.
Okay. Prashant, on the pharma space, if I see what you put out, year on year you see a growth that will come in, but on a quarter on quarter there is a decline, at least in most of the parameters. Why are you seeing this? What have you noticed?
So, couple of things here. I think the year on year growth is fairly obvious. I think pricing is much better now across through the year. You've seen industry growing. What we are worried about in the fourth quarter, so there are different things for different companies, but one common thing across we think is India will probably be a bit sluggish because there is some element of inventory correction in trade that continues to happen. This is something which we have seen for a while and we think will continue. So that's one part where we think there could be some decline. A lot of the rest would be just individual company related. So for example, if you take a Cipla, for example, usually the fourth quarter is always the weakest because they make a lot of their annual provisions during that quarter. Sun Pharma, which skews the entire aggregate numbers for the sector, will have an inventory correction event because they have merged their distribution group company into themselves. So it's these factors which will lead to the sequential correction. Otherwise, from a trend perspective, we don't think anything materially different from the third quarter will come through in this quarter's numbers, other than, as I said, the India bit could be a bit sluggish.
Okay. Well, within, just wondering, you and Darshan started off this conversation. We hear a lot of investors, and maybe they're a bit early in the game, talk about how they are now positioning themselves for a slightly longer run in the China opportunity in a big way. Some of the companies like DBs have already probably started showing in their numbers as well. What do you anticipate could happen to the quarter 4 earnings, and where do you find the highest beta?
Okay, so there are two opportunities that when we're talking about the China opportunity, there are two different sets of opportunities. One is the more opportunistic near-term one, which, while we don't cover these, is probably, where that comes from. So there's been big disruption in supplies from China, which includes API supplies, intermediates. So companies who are API companies have an opportunity to capitalize on that, because most companies would want to now validate an alternate source to make sure that they don't get left without supplies. So that's one, and that part does not really affect most of the larger companies that we cover meaningfully, because most of these are formulation companies. But that driver for many of the API companies, or even for companies like Dr. Reddy's, etc., who have small API businesses, to that extent they will benefit. The other opportunity which most of the larger companies are talking about is addressing China as a market itself. So out there we have seen signs, we've seen a few relaxations in terms of allowing international companies to come into the country. This includes lower approval timelines. This includes a lot of the provinces going into tender route, which allows new entrants to come in a lot quicker than they would otherwise have been able to. It also includes, just general relaxations in allowing non-Chinese generic companies to participate in hospital orders, etc. But these will take time because first you still need to go and get your products registered. Once you get and even with relaxations, it could take 2 to 2.5 years to get one product registered. So if you start now, I think a big part of that upside in financials will come over a 2-3 year time frame. So obviously it's a good big market to look at. The only company who could benefit at this point in time is Dr. Reddy's, because they have some small business there. But even that, it's a very small business in the overall scheme of things for them. So two sets of opportunities. The bigger companies will probably not see any meaningful benefit immediately.
You put it as a positive surprise, Apollo hospitals too, actually. We've seen that over the past few quarters, they have been improving. The Navi Mumbai operations are breaking even. AHHL probably over the next few quarters will be positive. So just wondering, why is it a positive surprise? The stock price has fallen because of different reasons. That's the pledge thing. But operationally, they have been doing well. So I just wanted to know how come it will be a positive. Is it a given that it will do well?
Yeah, so I see it will not be as much of a surprise as it was when it started doing well 2-3 quarters back. But our sense is that the extent of improvement will possibly surprise. So even in the December quarter, where stock actually reacted negatively because of the pledge issue, but December is the weakest quarter for the business, and they actually did better than the September quarter, which is the strongest for the business. So I think the nature of the improvement is probably a lot stronger than what most people seem to believe. So when we look at our numbers and when we look at consensus numbers, and this time it's a bit easier because the fourth quarter, so for everyone, we know the annual numbers. We are still a bit ahead of street. So to that extent, we believe that the improvement or the extent of improvement is not fully baked in, and that's what we've kind of highlighted.
Okay. Aditya, I want to come in on your coverage universe, and what is it that you are watching out for most? The delivery or the commentary? I'm sure it's a mixture of both. And what are the companies that one should be watching out for?
No, I agree. In fact, the consumer space is a little weird here. I think the fourth quarter will be a little more moderate than what we've seen previously. And again, I think it's very bottom up. We hear different companies tell us different things. I think factors like adverse seasonality, maybe competition in certain categories, some of the companies, domestic companies that are operating in overseas markets, some pressures there in Africa and other markets. Companies talking about a liquidity issue impacting the distribution chain, and so on and so forth. I mean, I think vis-a-vis where we are in terms of expectations, perhaps, we might see a moderation there. So I think commentary becomes very important on what really is happening on ground. In terms of our expectations for this quarter, I think by and large, we are actually forecasting a sequentially lower growth vis-a-vis what we had seen previously. I mean, with the exception of maybe some stocks like, say, Marico, where I think the company might actually deliver better than what it has been delivering, whereas for everybody else, if let's say they were delivering a high single-digit or a low double-digit volume growth, we might see a mid to high single-digit volume growth coming through. So it's kind of mixed across the board.
What about cost pressures and how do they play up? Because again, I'm guessing it's bottoms up and different for different companies. For Marico, I believe Shogata was telling me that the things seem to be turning around for the better, but it could be different for different companies.
No, you're right. I think Marico again stands out here because Copra is a very important raw material for Marico, and the swings are pretty sharp, right?
Sure.
So the impact that it can have is significant. So I think that's a call out that we actually have here. We think it actually allows Marico to invest a lot more behind new products, something which it's not really done too much in the last few years, or it's not really succeeded too much.
Yeah.
Also, I think it gives more resourcing for them to fight back at the economy end in the hair oil segment, where some of the unorganized players or players like Dabur have done very well in the last few quarters. So that definitely stands out. Other than that, you're right, absolutely right. It's a bit of a mixed bag. I don't think the impact of, say, crude or the rupee, actually this quarter might be a little better on a sequential basis. So whatever, it typically happens with a lag, so any adverse impact might actually come through in the subsequent quarters.
The other space, Aditya, we want to speak about is this media space, in which how difficult is it to estimate numbers given that the new TRAI orders are out? Is it going to be weak for the broadcasters? Will the DTH players probably benefit for this? How have you done this exercise for estimating numbers for the media space?
Darshan, it's definitely impacted growth for the broadcasters. We've actually taken a pretty sharp deceleration for both Zee and Sun TV. Interestingly, it's not only on subscription revenues, but also on advertising. So, I mean, on subscription, obviously, there is so much uncertainty. There have been blackouts in certain areas. So, numbers have definitely, the growth has definitely moderated. We have a 4-5% growth for both these companies. On advertising also, there have been issues around, the BARC, the Advertisers Council actually, telling people not to really follow the BARC ratings. So I think advertisers have also been a little more cautious on this. So we are taking a bit of a moderation, which I think will happen both in the fourth quarter as well as 1Q. I don't think things have normalized right now. So it's a bit of a wait and watch. I think things are still pretty, it's pretty volatile on ground. We have to see how temporary it is. I think it is temporary. Some of the larger broadcasters think they'll be able to come out of it. But I think we have to kind of see that pricing equilibrium, what consumers have selected and what finally comes through. On DTH, I think this quarter will be pretty soft operationally, simply because I think most of the company is sort of focused on migrating consumers rather than growing consumers. So I don't really think there'll be too much of a positive numbers there.
Interesting. We'll come back to some individual names, but Surendra, just dwell in on the other big elephant in the room, and which is financials. Now, interestingly, you believe that maybe there could be a potential negative surprise in ICICI and SBI. I'm not asking you to get into individual stocks, but if indeed the belief is that there will be a 44% earnings growth led by banks, and if these two large companies deliver a negative surprise, what's the ask rate for some of the others? And will this be a one-quarter phenomenon aided by lower base, or do you reckon that Q1, Q2 of the next years too, banking, corporate-facing banks largely, could keep on delivering numbers?
Yeah, so again, some of these earnings surprises that we are calling out are more timing-led issues.
Okay.
So it doesn't really change the trajectory of what we are expecting, but suppose the street was expecting some resolution in 4Q, it got pushed out to 1Q. So the 4Q number may be a little light versus expectations, which is what we are trying to call out. But that really doesn't change the thesis on the stock, because what we were expecting over a 2-year time frame is still intact. It just got pushed out by 1 quarter. So that's the kind of situation we are in, which is why we are saying that there may be some negative surprises versus what people are expecting for this quarter. But then again, some of those stocks are the ones where we have our biggest overweights. So our fundamental view is unchanged. It's just a timing issue, where some things may not play out as the street is expecting this quarter.
Okay, but would you expect that there could be a prolonged reaction if these misses do happen? Again, not getting into a specific stock, but if indeed there is a miss, but the commentary about what will happen in quarter 1, quarter 2 turns out to be okay. We've seen this a number of times with SBI in the past.
I think that should be fine. Again, not getting into stocks, but broadly speaking, yes, that should be fine, because the underlying story is still pretty much intact. Okay, see, the only thing one needs to be a bit careful is some of the stocks this year have been good outperformers. Right? So to that extent, whenever there is any adverse news on a stock which has already done well, you could see a bit of a pullback. But as you rightly say, if the commentary is good and whatever slipped in Q4, people come and say that it's going to come in Q1, I don't think it will be a big challenge from a stock price perspective.
Okay, just a follow-up, something that both Aditya or you can dwell upon. We spoke about a smaller FMCG name, Marico. The larger consumption space would be in focus for a lot of other companies as well. Where is it that you guys have the biggest earnings conviction on within the, not just the staple space, but the overall consumer space? Either of you.
Yes, okay. Maybe I'll start and he can add. See, from a consumer perspective, and again, if you kind of put autos also as a part of the same story. So right now, discretionary, and again, we covered some of the larger names. So the discretionary pack is possibly doing the best. Now again, one needs to keep in mind that some of them are gaining market share, right? And it's not a 1 quarter, 2 quarter. That story has been happening for 8, 10 quarters now. So that part of the consumption space is holding up the best. Staples is anyway a steady category. We are seeing a bit of a deceleration, but what we are saying is, okay, if somebody was growing 10, 11%, it will grow 8, 9%. So it's a deceleration, but not really a massive one. Autos is where you have really see the numbers come off. Okay, so that's the kind of order in which we see deceleration in the business on the consumption side.
If I was just to add specifically, I mean, he's absolutely right. In the discretionary names, some of the larger names that we cover, say Titan in the jewelry space or Jubilant Foodworks in the QSR space, I think the market or the industry may not be growing that much. Like jewelry clearly is not, as a space is not growing, but Titan is clearly gaining market share. They're clearly doing a very good job there. Or in Jubilant's case, I mean, you know, they've just been executing pretty well. So while there may be a moderation on the headline numbers, we still expect them to deliver a very decent growth profile there. So he's absolutely right. I think from an earnings comfort perspective, at least you think that the earnings growth profile A will be higher, and B, you know, at least the visibility is also that, you know, they'll at least deliver numbers which are better than the rest of the broader space.
Okay. Just a word on Godrej Consumer. That's a negative surprise. Care to dwell why you feel that this time around it will be a negative surprise?
I think they're going to have a tough quarter this time, particularly. I mean, I think their key insecticides business, which has been struggling for the last 1 year or so, has done very well previously. I think they've been impacted by the adverse seasonality this time. I mean, you know, the winter was fairly intense in some parts of India. Also, some of their overseas markets, you are facing certain issues in Africa and Latin America, due to which the headline numbers might be affected, and earnings, you could see some downside risk to earnings estimates. Having said that, I'm sure they'll get their way out. They managed it really well, but I think from a near-term perspective, we could see some softness in the growth.
And Prashant, leave aside Q4, FY20. In pharma, what's the theme that you are seeing could be will specialty be the theme? A lot of companies are getting into specialty drugs. Will that be the theme, or will generics again make a comeback, or will it be biologics? What's the sense that you're telling your investors?
See, I think the biggest theme or driver which probably is not well understood now. So I think US generics will see decent growth because pricing now, but all of that is well understood. Specialty has also been talked about, and a specialty product won't come suddenly out of nowhere. It stays in the pipeline for long, so it's kind of well seen. But I think one thing where we need to figure out and probably calibrate our numbers, etc., based on how managements talk about it, would be on the cost side. So there is enough indication now that most companies have started saying that look, the profitability of the business, especially on the generic side, is no longer the same, and we need to align our costs accordingly. So far, other than 1 or 2 companies, Dr. Reddy's being the notable one, no one's really put a number to it or really started doing anything meaningful other than saying that we are trying to see how we can be more efficient. I think as we move along now, you'll probably see more commentary on that coming from managements. Probably fiscal 20 guidance, that would be the most important thing to note. How they're guiding on margins, where are the margin levers, especially on the cost side. And I think that's one part which we and I think the street are not fully clear on, as to how much scope is there and how easy is it to really change your business structure or business model, the way you operate. So that could be the key to watch out for. Other than that, biosimilars could be a key year for someone like Biocon in terms of demonstrating that they are able to commercialize well. But I think I would, if there's one factor you have to look at, I would look at how management's guide on costs and therefore on margins.
Okay. Raashi, my final question to you, at least on this, is and taking off from where Surendra mentioned about cement and how the positioning seems to be underweight from clients. The valuations also seem to show a completely different picture, right? I mean, Shree Cement trades at valuations of what a consumer company might be, and at the same time, companies like India Cements, for example, just to quote a name, continues to trail, if you take EV per ton, at a valuation which is static and low. Now, based on this, what do you tell your clients? Do you tell them to buy value in the hope that there will be some bit of catch-up? Or do you tell them to buy the consumer cement names?
Well, I'd say most of the cement names are like consumer names, because at the end of the day, it is a branded commodity in India, right? And top down, we are positive on this space, right? Like whatever may be the election impact, the focus on the rural sector is going to continue, right? We're going to see the housing projects go on, the infrastructure impetus will continue. And we are positive across the space. But yes, we do have, like our top picks are ACC Ambuja and Ultratech, and you know, ACC Ambuja are cheaper than Ultratech, right? So it doesn't really fit into any one of the angles. The difference is ACC and Ambuja have a decent valuation story. There is a likely chance that they should re-rate up from what they've seen in the last few years. On the other hand, Ultratech is the largest player in India. It's exposed to all the markets, you know, and effectively people are not really needing to bet on any sort of region. Volume growth is the strongest. So it's really more of a top-down call, with these being the specifics. The other point is, you know, that sometimes if you look at like some of the southern players, because utilization levels tend to be low, you know, on an EV per ton basis, the nameplate capacity may not necessarily be reflective of what the actual valuation is. So I'd say, you know, one needs to look at it on a case-by-case basis, but not necessarily chase valuation in cement generally.
Okay, interesting. So, Surendra, my final question to you, I mean, maybe Darshan has one more, but my final question to you, would you, based on what happens in the quarter and the expectations, with an assumption that you lay a 20% expectation odd for FY20, what's fair value in the current scenario from an index perspective? Not necessarily quoting a number, but would you reckon that 18, 19 times where we might be currently, or 17, 18 times might be currently, is fair in the current context, or would you bat for a slightly lower multiple or maybe slightly higher multiple?
See, I think the multiple is a function of a lot of variables, right? The earnings outlook, macro outlook, flows. And obviously this year, the foreign flows have been surprisingly strong. We are already at what, maybe 8.5, 9 billion of inflows this year in just 3 months. So I think all those things become important, but I think the way I would kind of answer that question is, if you look at last 14, 15 years, in India, it's been extremely difficult to make money once the market is already at 18.5, 19 times, which is where we are today. If you take a longer term chart of multiples, it's very difficult to make money above that multiple. And which is what we are arguing, that we really don't see too much of upside from here. And in fact, if you see the December end target that we put out for the Sensex is pretty much where the Sensex is right now.
The counter argument to that might be that because earnings haven't been trending, don't necessarily look at PE multiples in isolation right now. The earnings will come back with a bang, and therefore these PE multiples might look indifferent. If you look at price to book, we might be a lot better valued, and maybe that's a right metric, etc., etc., etc. Do these come into conversations?
No, they do come. But having said that, I think the conviction on that argument has really gone down, because that argument has been there for 4 years and earnings have not come back with a bang, right?
Sure.
And at the same time, when you look at the economy, are you really seeing a lot of strength? Compared to 6 months back, now we are talking of a consumption slowdown. That was one of the bright spots. So when you put it all together, I think when people kind of get there, they see that on the economic side, there are things which are kind of telling them that yes, the earnings can recover, possibly what you are saying will play out. But at least in the near term, that doesn't seem to be the case.
What's the biggest risk that you all are factoring in? Is political risk a big risk that you're looking at, or is earnings slowdown? What's the sense that you're getting in because you speak to a lot of institutional investors? What are they telling you?
See, political risk is very difficult to price in, right? It's a binary risk, and which is why it's always very difficult to price in. At this point, the consensus view in the markets is what it is of stability and continuity. That is what the view is. Now, again, some people may talk of a thumping majority, some people may talk of not that kind of majority, but most people are working with that kind of a base case view. I think where the disappointment has come in, and when we meet investors, like I was in the US last week, I think people are really disappointed by the earnings trajectory. Okay, and in fact, when you start talking about earnings expectations for next year, generally you see clients are like, you guys tell me this every year, that next year earnings are going to grow 20%. So I think that is where we really need to see a couple of quarters where earnings are on track, the delivery comes in, and I think that's what will bring some conviction back into the markets.
I certainly hope it comes back sooner rather than later. But ladies, gentlemen, thank you so much for joining in today and giving us your perspectives. Always appreciate having you guys here.
Thank you.
Viewers, thanks for tuning into this broadcast from Bloomberg Quick.
What is the meaning of this word suspense?